Hi, this is the 5th of July, and we are looking at the chart of the Nifty. This is a weekly chart. I have essentially taken the entire time from the Feb 2016, March 2016 bottom, all the way to where we are. And as I was writing, some people do ask me how the target number of around 10,000, over 10,000 comes up. Is it a possible number? A lot of people are following it. And since there is clearly weakness in individual stocks, there continue to be those that are driving the indices higher. So the question comes up, and so I just wanted to highlight how this number comes about. And it's very simple. If you simply consider the size of the first wave and draw a channel around it, the upper end of the channel would have pointed to somewhere close to the 9,800 to 10,000 range. But if you just take equality, if you just say that the third wave and the first are equal to each other, then it would point to 10,360 odd. So that's where the number comes from. The question is really whether it will completely be achieved, and as long as you don't see a clear trend reversal, you would continue to anticipate it. Now, one of the ways that you do look for that is, if this is a third wave, you want to see 5 waves complete, and every time there is a 5 wave completion, you should be on the lookout for what we call as a 5 wave decline in the market. So this is the first structure that looked like 5, 1, 2, 3, 4, 5. Then one of the ways that you get extensions, to count extensions, is essentially to add 4 more waves to any count. So if you have 5 waves, if it extends, you get 4 more, because either if the third wave or the fifth wave extends, it converts into 9 legs. And so any number of extensions in an impulse end up adding 5 plus 4 plus 4, depending on how far it goes on. You could go to 9 to 13 to 17 to 21. Similarly, corrective waves also add up in a very, very similar way. So this is a little educational. And the first time you could see 5 was probably at the 92.20 high, 9218 to be exact. You added another 4 waves all the way up to 93.70, and you added another 4 waves all the way into the recent high that we are seeing at 97.09. Although it's more clearly visible on most other indices on Nifty. This particular week we didn't make a new high, but we did on most other indices. So if you consider that, it's completed approximately 13 waves for this entire structure. So once again, for the entire rise, you can actually call it a completed impulse, and if it extends, you'd have to add another 4 waves. So essentially, what you're looking for is the start of a 5 wave decline, break of maybe key levels to confirm that the trend is essentially reversed. So that's what I discuss in great detail in terms of various indicators, and what they're really looking like, and what we think of the near-term sell-off in terms of the wave structure that we've seen recently. And with that, I would like to then go into covering all the other updates. I also like to use a lot of trend lines. So essentially, when we see longer term impulsive patterns, they often fit very well into channels. So if I take this entire 2013-2015 period, you can nicely draw a channel around it with couple of touch points. But ideally, you should have 3 highs, 1, 2, 3, 4, 5, all of them touching, which you can see in most historical bullish phases, whether it be 2003, 2008 bull market. The entire trend fits on a trend line. You take the Y2K period, the entire 5 wave rise will essentially end up fitting the trend line with 2 supports, wave 2 and 4, and 1, 3 and 5 all at the upper end. So this pattern should be consistent. Of course, in this time period we had 2 touch points. The fifth one didn't really reach up there and appeared truncated, and for some while I actually doubted whether it is a 5 wave rise or a 3 wave rise. And so similarly, a lot of this advance here too did not had these trend lines breaking, but in the end essentially you could draw something from one of the interim lows that was supported a couple of times. But if you see this recent rally, we've actually seen multiple breakdowns. So if you take this and you keep drawing it, you find this the trend line just keeps breaking at each and every level. Essentially, as the market is losing momentum, which is why the weekly momentum indicators have already crossed into sell early before the market itself turning. But what we have is one trend line break here, and then I tried drawing a second one, which took at least these three lows together, and then that one broke in the month of May when you had the broader mid cap correction. And since then, so we are down to this last segment, and the last channel that I was trying to draw was essentially this one, which surrounds the entire price move from the April low to now, and that too has broken. And recently, we were trying to pull back in test this trend line. So it becomes an important test uh, because either you're going to hold it or else you would have to again redraw a new set of channels for an extension. But as long as it holds, it looks like this particular trend, at least on trend lines, is broken. So this pullback point where you're kissing the channel line, which is at yesterday's high, essentially becomes an important level to watch. So among the many charts that I've been posting online has been the 10-year and 30-year bond yields. I posted the 10-year last week and the 30-year this week. And the 30-year essentially I thought it would probably keep going up when there was weakness in the US markets, which was true for most of after March. The Dow didn't make a new high while the bonds were rising. So I usually call that the inverse relationship between US bonds and US equities. But we've recently seen, at least last week, both of them declining together, which was differential trend, and we'll have to see whether that change in relationship continues this week. What we've seen in the first couple of days is a continuation of the trend we saw last week, that is bond prices falling, which means bond yields going up in the US for the 10-year. The 10-year has already broken this rising channel that I've shown here, but the 30-year is just sitting on the rising channel. But so far, the 10 years fallen all the way down here that it looks like the 30-year should also follow. And once both have broken, essentially they would be in a much larger decline phase. So I think that's one of the trends that we would be tracking. The next chart, which took up a good amount of interest, was this one of the Karachi Stock Exchange, and I posted the long-term chart here, essentially showing that yeah, we are in a long-term fifth wave. And the last time I posted a chart of the Karachi index, it was in this fifth wave, and I was saying that it may not be over because the fifth wave did not achieve the upper end of the channel, and for such a big trend to see it simply truncate and crash over would be a little unusual. But we have seen a meaningful correction in the last 2 weeks in this index, breaking its weekly averages as well, which would almost give you a feeling that the trend is reversed. But it has previously taken support on the lower end of the channel, or the 20-week average, both of which coincide slightly here. So as long as if they do hold, I would still think that there could be more extensions on this chart. Otherwise, this fifth wave could end up completing. But right now, it still looks like probably a correction in the overall trend. The highlights of this week were the Nasdaq 100. This index, and I posted this chart yesterday. And the highlight is that it actually broke last week's low, and so the Nasdaq ended up being the weakest US index because the Dow actually made an intraday new all-time high on Monday, but the Nasdaq actually fell. So it was completely on opposite ends, and it's broken what looks visually like a head and shoulders pattern, and so we are below the neckline, and that indicates that you could probably see a further decline in the Nasdaq down to this level here near the previous swing that we saw in April. I also published the IT index this week, and it's been my long-standing view. I think for many years I've been marking this as a fifth wave, and I thought maybe it would have ended at this point itself when it touched this trend line. So I started calling it a high right there, which was way back 2014 it did that. And then 2015 it still made a new high, but the gains are not so significant. Almost giving back all of those gains and rolled over. So this so far this looks like a throwover and a rollover, and my sense is that having ended a fifth ending pattern, the IT sector would continue to remain under pressure, for the long term, which is what this chart suggests. And I've discussed even the short term structure, where may have completed a second and maybe starting a third wave down for the IT index. Very similarly, it was very interesting to see that the auto index, one of the outperforming sectors of this period, also has what looks like an ending structure for the entire period from 2015 to 2017. All the highs are along one trend line so far, and all the lows are along one trend line, and actually closed down for this month. As long as it stays within this structure, we'll be watching whether whether it starts to actually break down or break the lower end. Also, whether the most recent rise, which I've marked as E, confirms to be a three-wave rise, which would require some more decline in the sector index to confirm. And once it does, then this is most probably the case that we've actually ended a very long-term five-wave advance and are due for some kind of a correction or retracement. And lastly, let me touch upon the dollar index. It continues to remain a good, interesting debate online. I find some of the global macro analysts slowly beginning to turn and see the bear case on the dollar, but still there are many others who continue to believe that it should go higher for various fundamental reasons. But essentially, the chart itself completed, like I said, a three-wave structure for this entire rise, which I've marked as A, B, and C. For quite some time, EWI also held on to the idea that C is still in its fourth wave and a fifth would form and give you one more push to a new high. That's all they were looking for. But more recently, they have been confirming that C is most probably complete because of this most recent sell-off. And essentially, this most recent sell-off, according to me, is a five-wave decline. So I think you have the first impulse down here, which you can mark as 1, and all you'll probably get is wave 2 decline, bounce back, sorry. But the trend in the dollar, in my mind, should continue to be down for a while, and that while could be much longer than what you would anticipate, because as I've discussed in my previous posts, the dollar has gone through several bull and bear market cycles. Many of them, the bull market cycles lasting for several years, almost 9 years approximately, and the bear market cycles lasting for around 7 years. That has been the typical case since this data is available from Bloomberg all the way from around 1967. So what we have done is, if you see the first, if you actually look at these bear markets, they're actually pretty steep. It's actually the rallies that have been slow and steady with a lot of retracements, but the sell-offs have been almost one-sided. The second is that this bull run in the dollar essentially retraced 50% of the last bear run, and then again the recent high has been a near 61 to 66% retracement. So it just came close to 61, a little above that if I take it's 66%, which is one of the reasons that I considered this ABC to be complete, is that it was at a perfect retracement, and the overall structure therefore is a lower top, lower bottom, longer term for the dollar. Some people had started to draw a big wedge around this pattern, which I don't know if it's valid or not. You can argue both ways, and just like you'd want to argue the bullish case for this triangle, sometimes what I do is if you simply inverse a chart, you'll see the opposite case also, and the opposite case would then be more that the dollar is forming some kind of an ending structure. So it's forming some kind of a triangle which is still not complete on the downside. Of course, this is now an upside down chart, so if it goes up, it will mean going down. If I redraw these lines, then I would be looking at a move that goes all the way to the lower end. So these are longer term considerations, that you've completed a three-wave structure and you could end up going into a 7-year kind of bear market for the dollar, and that's something that most people do not have in their consideration. So these are many of the trends that I keep writing about and discussing. Many of the posts are online. Some of them in the insiders, some of them are freely there to read. I've covered most of the free ones, and you can find them there on an ongoing basis. I continue to publish them daily as each and every trend develops, covering commodities and currencies as well. So that's all in this update. Thank you.